Google is an incredible business, high cash flow, low debt, and it absolutely owns the online world of advertising. They do such a great job. Oh, and by the way, they own the top 2 search engines in the world, Google.com and YouTube.com. You don't realize it, but YouTube.com is the second largest search engine in the world. Whenever anybody wants to learn anything, where do they go? They go to YouTube.com. You're here right now learning from me, with us, from YouTube.com. So let's go check out Google and our software. So if you have our software, please follow along. It's a great way to get better. So Google's down. It just recently split 20 for 1. That's why the price is at 115, and it's down 2% today. It is a low day in the market, but this is something to understand that when the most overpriced when the market goes down, overpriced companies tend to drop the most, less overpriced tend to drop the least. So we're going to see where Google stands in that level and spectrum. So over the last year, they hit a high of 150, which was $3,000 a share before the split, and a low of 101, which is about $2,000 a share before the split. So it's on the lower end of that range right now. No dividend, but some very interesting aspects. High return on invested capital, very good profit margin, gross margin of 57%, and overall profit margins that are very consistent over the last 5 years. We have a 5-year profit margin of 23.2%, and last year's profit margin of 25.9%. So let's go to our 8 pillars tab real quick to give the recap of our 8 pillars. Now, you'll see right here, 2 things stand out. 2 X's, the first and last pillar. These are our valuation metrics, the 5-year PE and the 5-year price of free cash flow. 34.7 and 37, pretty much on the nose. Okay, that's immediately an X because we want both those numbers under 22.5. But does that mean we shouldn't buy the company? Well, hang on a second. Just remember, if Google were able, hypothetically, to grow its revenue and profit by 30% or more per year for the next 10 years, I would absolutely buy this company right now on those multiples. Because the multiples are contingent on what? It's contingent on growth and moat. And I think we'd all agree that Google has quite the moat when it comes to online advertising and YouTube. It's going to be hard to take them over. But do they have the growth potential in them? I don't know. So Google is also buying back some shares, which I'm not really a fan of in this model. When companies are expensive, have high PEs, we don't want the company buying back shares. Buying back shares is very attractive for companies because it can boost the earnings per share, and it's actually good for investors if you're buying back shares of a company, giving the investor a bigger piece of the pie. However, when they're buying back their shares and their shares are expensive, they're overpaying for stock. Even if it's their own company, it's like buying another company at a much higher price. So I don't really like that too much. Look at this debt level. They can pay off all their long-term liabilities with 1 year of free cash flow. That's incredible. Increase of cash flow in the last 5 years of $44 billion, increase of profit of $55 billion, and increase in revenue of $154 billion. So guys, all around, this is a company that screams buy once the price is the right price. But remember, it's very possible to overpay for a good thing. In fact, that's usually what happens. Stocks are a voting machine in the short run and a weighing machine in the long run. Whatever is the most popular will get big price jumps in the short run, but what matters is the long run. So don't overpay for a company just because you love the company. Don't fall for that trick. Don't overpay for a company because it's growing fast. Growth eventually slows. So we need to use the tools that we have in our software to determine all these things before we go do more research and decide when to buy the company. So if you're new to this channel, I'm Paul. I'm a value investor. As you can tell, I don't want to overpay for things. I want to sit there and use the quantitative aspects of a business to decide if I should go further and research it further in order to buy. I don't believe in overpaying for hype, for growth, or any of these things. We have over 1,700 videos in our collection. Go watch them, especially from a year and a half ago when I was saying no to all the hype stocks that have now fallen 70, 80, 90%. The ones that haven't, I still think will fall eventually. It just hasn't happened yet. Things like Tesla and Amazon. And that's fine. But my goal is to buy $1 for much less when the market has mispriced the asset. So now we've done this look at the 8 pillars for Google. So the next question is, what price should I pay? That is why we have the stock analyzer tool. Because if you remember, every investment is the present value of all future cash flow. But we don't know what the future holds. All we can do is make assumptions and hope that our range of assumptions are accurate. So we have the stock analyzer tool that we created in order to do this. We first start with the number of years of analysis, 1 to 20. I always pick 10. Now, guys, if you're serious about investing, I want you to do me a favor. I want you to rewatch this section a few times. It's going to go through my thought process of how I look at assumptions for the future. I want to be conservative. I don't want to assume major assumptions. Some of the mistakes I've seen in the past is when, actually all mistakes I've seen in the past is when assumptions don't pan out, which is very frequent, and people make gross assumptions about the future. That is where people get into danger. Look at Tesla right now. I think the assumptions made about the future are absolutely egregious. So we want to make sure we're conservative and we find opportunities to buy when those conservative, the price is selling for less than those conservative assumptions make it out to be. So revenue growth. 1, 5, and 10 years. In the last 10 years, Google's done 21% a year. Last 5 years, 22.4, and last year, 26. So it actually looks like their rate of growth is increasing. But again, they're already huge. So the faster and faster you grow, the more you grow, the slower and slower you're going to grow in the future. So I'm going to do 8, 11, and 14% revenue growth. All right. Now, 14% revenue growth is still a lot. It still doubles every 5 or 6 years. That's really, really good. So that'll take Google to almost 4 times more revenue in 10 years than it is today. So just keep that in mind before you think I'm being too conservative. Now for profit margin, like their revenue growth, their profit margin is getting better over time. Again, I don't necessarily want to assume that profit margins continue to go up. However, profit margin is more likely to stay up than it is revenue growth because they can keep those margins going. But we're at the end probably of a cycle of a good economy and growth. Profit margins tend to be higher during these times. So for my profit margin, I'm going to do 20, 21.5, and 23. Free cash flow margin, I'm actually going to do exactly the same thing because profit margin and free cash flow margin should be very similar to each other over long periods of time, just like earnings and free cash flow should be very similar over long periods of time. Now, these next two are based on multiples of earnings and free cash flow. But I want you to remember, we want the PE and price of free cash flow assumptions to be where we would assume that it'd be in 10 years, not today. And remember, the larger the company becomes, the slower the growth is going to be. And growth to me is one of the 2 most important parts of factoring in a PE. The other one is moat. I don't think the moat is questionable here for Google. No, I don't know many people who use any other search engines. Google is the dominant one. And they also have YouTube, which you're watching us on right now, the number 2 search engine in the world. So Google owns the top 2 search engines in the world. That moat is solid. They're simple and they're great. But as they grow, they're not going to be able to grow as fast in the future. So I want to go down on my assumptions for PE. So I'm going to do 13, 15, and 17. Now, my desired annual return. Guys, for a big company like Google with a great balance sheet, I'm okay with a 12.5% return. They have a great balance sheet, low debt, and on a regular ETF, you can get 9 or 10%. So I want a little bit more margin of safety and a reason for buying the stock. So I do 12.5%. Now, I'm going to hit the analyze button. When we scroll down below, the stock's at 114. If it's all green, that doesn't mean go out and buy everything. It means verify these numbers. If you're not part of our community yet, join the community. Spend the less than cup of coffee per day to get access to thousands of people who are talking about stocks every single day. There's somebody in that community. There's lots of people in that community who've looked at Google. Go learn from what they found. It's better to do research as a whole than individually. If it's all red, it doesn't mean ignore it. The stock's at 114. If it's pretty close, let's say the price is 100, then go add it to your watch list. It'll get added to your watch list and it'll notify you through the app and through the website and through email when the stock has hit your price list on the watch list, okay? So hit the analyze button, boom. Low end, 65, high end, 137, in the middle is 95. So what am I doing? I'm actually gonna add it. I'm actually gonna add it 100. Notify me. So now the software is gonna notify me at $100, but it's a great starting point. So if you like this video, please watch our next video on our 8-pillar process to understand it in more detail. And please subscribe to our channel if you enjoyed it. Thank you very much for your time.